I need to tell you something that might save your retirement. Something that financial advisors rarely explain because it contradicts the simple advice they have been giving for decades. Something that has caused millions of retirees to sabotage their own financial security while thinking they were being conservative and smart. Most retirees get dividend investing completely wrong, and I mean completely wrong, not slightly wrong, not a little bit off. They are making fundamental errors that will cost them hundreds of thousands of dollars over their retirement, errors that will force them to lower their standard of living, errors that might cause them to run out of money entirely. I have been investing for over 70 years. I have watched generations of retirees make the same mistakes over and over again. They chase yield, they ignore sustainability, they confuse income with safety, they build portfolios that look perfect on paper but crumble when tested by reality. And the tragedy is that these mistakes are entirely avoidable if you understand a few basic principles that Wall Street does not want you to know. Today, I am going to explain the dividend strategy that most retirees get wrong. I am going to show you why the conventional wisdom about retirement income is dangerously flawed. And I am going to teach you how to actually build a dividend portfolio that will support you for decades without the risk of catastrophic failure. Let me start with a story that illustrates everything wrong with how retirees think about dividends. Back in 2007, there was a company called Washington Mutual. It was the largest savings and loan in America. Solid, respectable, a household name. And it paid a dividend yield of over 6% for retirees looking for income. Washington Mutual seemed perfect. A big bank with a long history paying a generous dividend. What could go wrong? I talked to retirees back then who had put huge portions of their savings into Washington Mutual specifically because of that dividend. They told me they needed the income. They told me the 6% yield was so much better than what they could get from Treasury bonds. They told me banks were safe. They told me Washington Mutual had been paying dividends for years. By September 2008, Washington Mutual was bankrupt, the largest bank failure in American history. The stock went to zero. The dividend obviously disappeared. Retirees who had concentrated their savings in Washington Mutual for that 6% yield lost everything, not just the dividend, everything. Now you might say that was an extreme case. That was the financial crisis. That was exceptional circumstances. But here's the thing, it was not exceptional at all. The same pattern repeats constantly. Retirees chase high dividend yields. They concentrate in stocks that pay the most. They ignore the warning signs, and they lose fortunes when those dividends get cut or eliminated. General Electric was another example for over a century. GE was considered one of the safest dividend stocks in America. Blue chip, industrial giant, paid dividends continuously since 1899. Retirees owned it for generations. Then the dividend was cut, and cut again from over $1 per S-hair to just a penny. Retirees who depended on that income saw it evaporate while the stock price collapsed. ANNT, another supposed dividend stalwart. Retirees loved it for the yield. Then the company spun off Warner Media, cut the dividend by nearly half, and the stock cratered. Income investors who bought for that 7% yield suddenly had half the income and massive capital losses. I could give you dozens more examples, hundreds, because this pattern is not the exception. It is the rule. High dividend yields are often a warning sign, not an opportunity. And retirees who chase yield without understanding this are setting themselves up for disaster. Let me explain the first major mistake retirees make with dividends. They focus on current yield instead of dividend safety and growth. This is the most common error and the most destructive. When a stock has a very high dividend yield, there are only two possible explanations. Either the company is genuinely earning so much money that it can afford to pay a huge dividend sustainably, or the stock price has fallen because the market recognizes problems with the business, and the high yield is a mathematical artifact of that falling price. The second explanation is correct, far more often than the first. A stock yielding 8% is usually not a bargain. It is usually a company in trouble whose stock price has declined and whose dividend is likely to be cut. Think about this logically. If a company could genuinely sustain an 8% dividend yield, institutional investors would bid up the stock price until the yield fell to more normal levels. The fact that the yield remains abnormally high tells you that sophisticated investors do not believe the dividend is sustainable. They are staying away. Only retail investors, often retirees desperate for income, are buying. I call these situations yield traps. They look attractive on the surface: high current income, established company, regular dividend payments. But underneath, the business is deteriorating. Cash flows are declining. Debt is mounting. The dividend is being paid out of borrowed money or by depleting assets rather than from genuine earnings. When you buy a yield trap, you get a few quarters or maybe a few years of attractive dividends. Then the inevitable happens. The dividend gets cut, the stock price crashes. You lose far more in capital than you ever received in income. You would have been better off in a boring treasury bond. The retirees who lost everything in Washington Mutual were caught in a yield trap. The retirees who suffered through GE's collapse were caught in a yield trap. The retirees who bought A&T for income were caught in a yield trap. The same story plays out constantly with different company names. So how do you avoid yield traps? You have to analyze dividend sustainability, not just current yield. You have to look at payout ratios. You have to examine cash flow trends. You have to understand the competitive position of the business. You have to ask whether the dividend can be maintained and grown over decades, not just paid next quarter. The payout ratio is simply the percentage of earnings or cash flow that a company pays out as dividends. If a company earns $4 per S-share and pays a $2 dividend, the payout ratio is 50%. That leaves room for the dividend to be maintained even if earnings decline somewhat. It leaves room for the dividend to be increased as earnings grow. But if a company earns $4 and pays a $4 dividend, the payout ratio is 100%. There is no margin of safety. Any decline in earnings means the dividend must be cut, and there is no earnings being retained to grow the business. Worse, some companies pay dividends that exceed their earnings. They fund the dividend by taking on debt or selling assets. This is completely unsustainable. It is a company slowly liquidating itself to maintain appearances. The high yield is an illusion funded by destroying the business. When I look at dividend stocks, I want to see payout ratios below 60% for most companies. Lower for cyclical businesses that might see earnings fluctuate. I want to see free cash flow that comfortably exceeds the dividend. I want to see a track record of maintaining the dividend through recessions. These are the markers of sustainable dividends that will actually be there when you need them. The second major mistake retirees make is ignoring dividend growth in favor of high current income. This mistake is more subtle but equally damaging over a long retirement. Suppose you are 65 years old and retiring with $1 million. You have two options. Option A pays a 5% dividend yield today but has not grown its dividend in years and is unlikely to grow it in the future. Option B pays only a 2.5% dividend yield today but has been growing its dividend by 8% annually and will likely continue doing so. Most retirees choose option A. They need income. Now, 5% is twice as much as 2.5%. Simple math, right? But let us follow these two options over a 20-year retirement option. A pays you $50,000 in year one, $50,000 in year two, $50,000 in year 20. The income never changes, but inflation does change. If inflation averages 3% annually, that $50,000 in year 20 has the purchasing power of only about $27,000 in today's dollars. Your real income has been cut nearly in half. Option B pays you only $25,000 in year one. But with 8% annual dividend growth, by year 10 you are receiving about $54,000 by year 20, you are receiving over $116,000 annually, even after adjusting for inflation. Your purchasing power has grown substantially, and that is just the income comparison. The total return comparison is even more striking. Companies that grow their dividends consistently tend to be healthy, growing businesses. Their stock prices appreciate along with their earnings and dividends. Option B will likely have significant capital appreciation over 20 years. Option A, with its stagnant dividend, probably has stagnant or declining business fundamentals. The stock price may go nowhere or even decline. The retiree who chose option A for the higher current income ends up poorer in every way, less real income, less capital appreciation, more risk because the stagnant dividend suggests a struggling business. This is the tyranny of current yield. Retirees focus so much on maximizing today's income that they sacrifice tomorrow's income and long-term wealth. They end up with portfolios full of slow, growing or declining businesses that cannot keep up with inflation. The solution is to focus on dividend growth, not just dividend yield. Look for companies that have increased their dividends consistently for many years. The so-called dividend aristocrats have raised dividends for at least 25 consecutive years. Dividend kings have raised dividends for 50 years or more. These companies have demonstrated through recessions, through market crashes, through every kind of economic challenge that they can sustain and grow their dividends. A company that has raised its dividend for 50 consecutive years is telling you something important. It is telling you that management prioritizes returning cash to shareholders. It is telling you that the business generates consistent, growing cash flows. It is telling you that even during difficult times, the dividend was protected. This is the kind of company you want to own in retirement. The third major mistake retirees make is over concentrating in dividend stocks while ignoring total return. This is a conceptual error that leads to poor portfolio construction. Many retirees believe they should only own dividend, paying stocks because they need income. They avoid growth stocks entirely because those stocks do not pay dividends or pay very small dividends. They build portfolios that are heavily concentrated in utilities, real estate investment trusts, telecommunications, and other high-yield sectors. This concentration creates several problems. First, it eliminates diversification. All those high-yield sectors tend to move together. They are all sensitive to interest rates. When rates rise, utility stocks fall, REIT prices fall, telecom stocks fall. Your supposedly safe income portfolio can drop 20 or 30% in a rising rate environment. Second, it excludes some of the best businesses in the world. Many of the highest quality companies pay small dividends or no dividends at all. They reinvest their earnings at high rates of return and grow their businesses. Over the long term, these growth companies often deliver better total returns than high-yield stocks. By excluding them, you are handicapping your portfolio. Third, it confuses income with total return. Here is something that took me years to fully appreciate. Whether a company pays you a dividend or retains earnings to grow the business, your wealth increases by the same amount. And if the company earns $10 per share and pays it all as a dividend, you have $10 in cash. If a company earns $10 per share and retains it all, your shares are worth $10 more. Either way, you are $10 richer. The difference is just in what form you receive the value. With dividends, you get cash. With retained earnings, you get capital appreciation. But the total value created is identical. There is no magic to dividends. They are just one way of receiving value from a business. This means that a retiree who needs income does not necessarily need dividend stocks. They need total return. If your portfolio grows by 8% annually, you can sell some shares to generate income equivalent to a 4% dividend yield and still have your portfolio growing at 4%. The source of the cash, whether dividends or share sales, does not matter. What matters is the total return. In fact, generating income through selective share sales can be more tax efficient than receiving dividends. Dividends are taxed as ordinary income or qualified dividends. Capital gains from share sales may be taxed at lower long-term capital gains rates, and you have control over the timing and amount of capital gains you realize. I am not saying you should avoid dividend stocks. Many wonderful businesses pay attractive dividends, and I own plenty of them. What I am saying is that you should not limit yourself to dividend stocks just because you need income. A balanced portfolio that includes both dividend payers and growth companies will likely deliver better long-term results than a portfolio concentrated entirely in high-yield stocks. The fourth major mistake retirees make is spending all their dividends immediately instead of maintaining flexibility. This is a behavioral error that seems logical but creates problems. The traditional advice for retirees is to live off their dividends and never touch the principal. This sounds conservative, it sounds sustainable. It sounds like the way your grandfather managed his money, but it has significant drawbacks. First, it ties your spending to your dividend income rather than your actual needs and portfolio value. Suppose your portfolio generates $40,000 in dividends, but your expenses are $50,000. If you rigidly refuse to touch principal, you either have to cut your lifestyle or generate income some other way. But your portfolio might be worth $1.5 million. Spending an extra $10,000, less than 1% of principal, is completely reasonable and sustainable. The rigid dividend only rule creates artificial constraints. Second, it prevents you from taking advantage of portfolio rebalancing over time. Some investments will outperform and become too large a portion of your portfolio. Others will underperform. Prudent portfolio management involves periodically selling winners and redeploying into other opportunities. If you never sell anything because you only spend dividends, your portfolio becomes increasingly unbalanced. Third, it causes you to over-concentrate in high-yield investments to generate enough dividend income. If you need $50,000 in annual income and you insist on getting it all from dividends, you need a yield of 5% on $1 million portfolio. To get that 5%, you have to reach for yield, which brings all the problems I discussed earlier. If instead you were willing to supplement dividends with selective share sales, you could build a more diversified portfolio with higher quality companies that happen to pay lower dividends. The better approach is to think in terms of a sustainable withdrawal rate from your total portfolio, regardless of how that withdrawal is funded. Financial research suggests that a 4% withdrawal rate is generally sustainable over a 30-year retirement. That means if you have $1 million, you can spend about $40,000 per year, increasing for inflation, with high confidence of not running out of money. Whether that $40,000 comes entirely from dividends, entirely from share sales, or some combination does not matter. What matters is that your total portfolio can sustain the withdrawal. This gives you flexibility to own the best investments, regardless of their dividend yield, and to adapt your strategy as circumstances change. The fifth major mistake retirees make is ignoring the tax implications of dividend investing. This is especially important in retirement when every dollar of after-tax income matters. Dividends are taxable in the year they are received. You have no control over this timing. If a company pays a dividend in December, you owe taxes on that dividend in April, regardless of whether you needed the cash or what your other income was that year. Capital gains, by contrast, are only taxable when you sell shares. You control the timing. You can harvest losses to offset gains. You can time sales to years when your other income is lower. You can manage your tax bracket strategically for retirees in higher tax brackets. A portfolio that generates excessive dividends can create unnecessary tax drag. Every dollar paid in taxes is a dollar not compounding in your portfolio. Over a 20 or 30-year retirement, the difference between a tax-efficient and tax-inefficient strategy can be hundreds of thousands of dollars. This does not mean you should avoid dividends entirely. Qualified dividends receive favorable tax treatment. Dividends received in tax-advantaged accounts like IRAs have no immediate tax impact, But it does mean you should think about the after-tax return, not just the headline yield. Some retirees would be better off with growth stocks that pay minimal dividends held in taxable accounts, while their dividend stocks are held in IRAs. The dividends in the IRA grow tax deferred. The growth stocks in the taxable account generate minimal current taxes while appreciating. When you need cash, you can sell shares strategically or take IRA withdrawals, depending on your tax situation that year. This kind of tax-aware portfolio construction can add significantly to your after-tax wealth over a long retirement. But it requires thinking beyond the simple dividend equals income framework that most retirees use. The sixth major mistake retirees make is failing to understand that dividend cuts are devastating and that preventing them should be a priority. Many retirees think of dividend cuts as minor inconveniences. The income goes down a bit, but you still have the stock. Right, wrong. Dividend cuts are catastrophic for retirement portfolios. Here is why. When a company cuts its dividend, the stock price almost always falls significantly, often by 30, 40, 50% or more. This is because dividend investors flee the stock when it no longer meets their income needs. The market also correctly interprets the dividend cut as a signal that the business is in trouble. So you lose twice. You lose the income you were depending on, and you lose a huge chunk of your principal. If you had $100,000 in a stock paying 5%, you were receiving $5,000 annually. If the dividend gets cut in half and the stock drops 40%, you now have $60,000 in principal generating only $1,500 in income. Your wealth has been devastated. This is why dividend safety is so much more important than dividend yield. A safe 3% yield that never gets cut is infinitely better than an unsafe 6% yield that gets slashed. The high yield seems more attractive until the cut comes. Then you realize you would have been better off with the lower but safer income. When I evaluate dividend stocks, I focus primarily on safety. Can this company maintain and grow its dividend through a recession? Does it have low debt? Does it have stable recurring revenue? Does it have competitive advantages that protect its profits? Has management demonstrated commitment to the dividend through past difficult periods? Only after I am confident in the dividend safety do I look at the yield. A safe dividend at a reasonable yield is a good investment. An unsafe dividend at a high yield is a trap waiting to spring. Let me tell you how I think about building a dividend portfolio that actually works for retirement. It is very different from what most financial advisors recommend. First, I prioritize quality over yield. I would rather own a company yielding 2% with a rock, solid balance sheet, growing earnings, and a 20-year track record of dividend increases than a company yielding 6% with high debt, declining revenue, and an uncertain future. The low yielder will grow its dividend and appreciate in price. The high yielder will probably cut and crash second. I diversify across sectors, but not into bad businesses. I want exposure to different industries so that problems in one sector do not devastate my portfolio. But I will not own a low-quality company just to check a diversification box. If I cannot find a quality dividend payer in a sector, I skip that sector. Third, I include some growth investments, even though they pay low or no dividends. The capital appreciation from quality growth companies funds my retirement just as effectively as dividends. A balanced portfolio grows faster and is more resilient than an all-dividend portfolio. Fourth, I focus on dividend growth rates, not just current yield. I want companies that will be paying me twice as much in 10 years as they pay me today. That dividend growth protects me from inflation and increases my income over time. Fifth, I maintain flexibility. I do not rigidly insist on never touching principal. If I need to sell some shares to fund an expense or rebalance my portfolio, I do it. The goal is maximizing long-term wealth and sustainable income, not adhering to arbitrary rules. Sixth, I pay attention to valuation. Even a great dividend stock can be a bad investment if you pay too much. I want to buy quality dividend payers at reasonable prices, which usually means avoiding stocks that have become popular and expensive. Seventh, I watch for warning signs. If a company's payout ratio is rising, if debt is increasing, if earnings are declining, if management is making excuses, I pay attention. These are signals that the dividend might be in trouble. I would rather sell a stock before a dividend cut than hold through the devastation. Let me give you some examples of the kinds of companies that belong in a retirement dividend portfolio. Companies like Johnson & Johnson that have paid dividends for over a century and raised them for over 60 consecutive years. Companies like Procter & Gamble that sell products people need regardless of the economy. Companies like Coca-Cola that have brands so powerful they can raise prices every year. Companies with reasonable payout ratios, strong balance sheets, and consistent earnings growth. These companies might yield only 2 or 3%. That seems low compared to the 6 or 8% yields you can find elsewhere. But these dividends are safe. They will grow. The companies will appreciate. And you will not wake up one morning to find that your income has been slashed and your principal destroyed. The retirees who build portfolios full of these quality dividend growers will have secure, rising income for decades. The retirees who chase yield will lurch from one dividend cut to another, watching their wealth erode while wondering why the strategy that seems so smart is not working. Let me close with the most important lesson of all. In retirement, you cannot afford catastrophic mistakes when you are young and working. You can recover from investment losses. You have time, you have income, you can rebuild. When you are retired, depending on your portfolio for living expenses, you cannot recover. A 50% loss in your portfolio might mean going back to work or drastically cutting your lifestyle or running out of money before you die. This asymmetry means that protecting against disaster is more important than maximizing returns. A portfolio that earns 7% annually with no chance of catastrophic loss is far better than a portfolio that earns 10% annually with a meaningful chance of losing half. Yield dividend investing, as practiced by most retirees, has a meaningful chance of catastrophic loss. The stocks they buy are often troubled companies with unsustainable dividends. The concentration in high-yield sectors creates vulnerability to interest rates and sector-specific problems. The lack of diversification into growth companies limits upside while not reducing downside. Quality dividend growth investing, combined with appropriate diversification and flexibility, has a much lower chance of catastrophic loss. The companies are stronger, the dividends are safer, the portfolio is more balanced. Yes, the starting yield is lower, but the ending wealth is almost certainly higher. I have watched generations of retirees make these mistakes. I have seen the devastation when dividend cuts destroy portfolios. I have seen the slow erosion when inflation, ignoring high yield portfolios, lose purchasing power year after year. And I have seen the success when retirees focus on quality, growth, and sustainability instead of chasing yield. Everything, about dividend investing is probably wrong if you learned it from conventional financial advice. The strategies that sound conservative are often reckless. The strategies that seem to maximize income often minimize wealth. The simple rules that are easy to follow lead to poor outcomes. Real dividend investing for retirement requires deeper analysis. It requires understanding business quality, not just counting yield. It requires patience to accept lower current income in exchange for growing future income. It requires flexibility to adapt your strategy as circumstances change. And it requires the discipline to avoid the yield traps that destroy so many retirement portfolios. I have built my fortune through patient, quality-focused investing. The same principles apply to dividend investing for retirement. Focus on quality, be patient, think long-term, and never chase yield at the expense of safety. That is how you build a dividend strategy that actually works. Now let me go deeper into some specific situations that trip up retirees, because I see these patterns constantly. The first trap is what I call the utility illusion. Retirees love utility stocks. They seem perfect for retirement portfolios, essential services, regulated businesses, stable demand. Consistent dividends. Your grandparents probably owned utility stocks. The advice to buy utilities in retirement has been handed down for generations. But the utility sector has changed dramatically, and many retirees have not noticed. Electric utilities now face competition from solar panels and battery storage. Natural gas utilities face uncertainty about the long-term future of fossil fuels. Regulated utilities face pressure from state commissions that want to keep rates low. The stable, predictable utility of your grandfather's era is increasingly a thing of the past. More importantly, utilities are extremely sensitive to interest rates. When rates rise, utility stocks fall. This is because utilities are often valued as bond alternatives. When actual bonds start paying attractive yields, investors sell utilities to buy bonds. The stock prices decline even though nothing has changed about the underlying business. I watched this happen in 2022 and 2023. As interest rates rose rapidly, utility stocks got crushed. Some declined 30 or 40%. Retirees who thought they were being conservative by overweighting utilities saw their portfolios devastated. The supposedly safe sector turned out to be highly volatile. Utilities can be part of a retirement portfolio, but they should not dominate it. And you need to understand that their stability is partly illusory. When conditions change, utility stocks can fall just as hard as any other sector. The second trap is the real estate investment trust obsession. REITs are required by law to pay out at least 90% of their taxable income as dividends. This results in high yields that retirees find irresistible. Many retirees build portfolios that are heavily weighted toward REITs, specifically because of those yields. But REITs carry risks that are easy to overlook. They are highly leveraged. Real estate is typically financed with significant debt, and rising interest rates increase borrowing costs and reduce property values. Many REITs have suffered enormous losses when rates rose or when real estate markets weakened. Different types of REITs have different risk profiles. Office REITs have been devastated by the work from home trend. Retail REITs have struggled with the shift to e-commerce. Hotel REITs got crushed during the pandemic. Even apartment REITs can suffer when new supply floods the market or when rent control legislation threatens returns. The high yields that REITs pay are not free money. They compensate investors for real risks. Retirees who overweight REITs because of the yields often do not appreciate these risks until they suffer painful losses. I am not saying avoid REITs entirely. Some REITs own irreplaceable properties and have excellent management, but you should understand what you are buying and not concentrate your portfolio in a single asset class just because it pays high dividends. The third trap is the fallen angel fantasy. A fallen angel is a stock that used to be a market darling but has declined significantly. Often these fallen angels still pay dividends that look attractive relative to the reduced stock price. Retirees see a famous company at a big discount with a high yield and think they are getting a bargain. Usually they are not. Usually the stock has fallen because the business is genuinely impaired. The high yield is not an opportunity. It is a reflection of problems that will likely result in a dividend cut. I see retirees buying fallen angels constantly. A pharmaceutical company whose key drug lost patent protection, a retailer losing market share to Amazon, a bank with deteriorating loan quality. These stocks often yield 5 or 6 or 7% because their prices have collapsed. The yields look attractive compared to treasury bonds or money market funds. But the high yield is a trap. The businesses are in decline. The dividends are not sustainable. Buying fallen angels for yield is usually buying future dividend cuts and further capital losses. Sometimes fallen angels do recover. Sometimes a company turns around and rewards investors who bought during the downturn. But more often, the decline continues. The dividend gets cut. The stock falls further. The retiree who thought they were getting a bargain ends up with losses. If you are considering a fallen angel, you need to do serious work to understand why the stock has fallen and whether recovery is likely if you cannot explain specifically what will change to improve the business. You are probably catching a falling knife rather than finding a bargain. The fourth trap is recency bias in dividend growth. Retirees love to see a track record of dividend increases. Companies that have raised their dividends for 10 or 20 or 30 years seem safe. The pattern of increases suggests stability and reliability, but past dividend growth does not guarantee future dividend growth. Economic conditions change, competitive dynamics shift, management priorities evolve. A company that raised its dividend every year for 2 decades can cut it suddenly when circumstances change. I think of General Electric again. GE raised its dividend for decades. It was considered one of the most reliable dividend stocks in America. Then the business deteriorated and the dividend was slashed multiple times. The long history of increases gave investors false confidence. When evaluating dividend history, you need to look at what enabled those increases. Was it genuine business growth? Or was it financial engineering, rising payout ratios, increasing debt? A company that raised its dividend by depleting its balance sheet is not the same as a company that raised its dividend through growing profits. I also look at how the company behaved during recessions. Did they maintain the dividend during 2008 and 2009? Did they maintain it during the pandemic? Companies that protected their dividends through genuine economic stress have proven their commitment. Companies that cut during tough times may do so. Again, the fifth trap is ignoring the opportunity cost of safe but low return investments. Some retirees become so focused on safety that they put large portions of their portfolio into treasury bonds, CDs, or money market funds. These investments are indeed safe. You will not lose principal, but the returns may not keep up with inflation, and over a long retirement, that matters enormously. If you are 65 years old, you might live another 30 years. That is a very long time horizon. A portfolio that earns 2% annually when inflation is 3% is losing purchasing power every year. After 30 years, you will have significantly less real wealth than when you started. This does not mean you should avoid safe investments entirely. Some portion of a retirement portfolio should be in lower risk assets for stability and to fund near-term expenses, but overweighting safety to the point where your portfolio cannot grow is a mistake. The right balance depends on your individual circumstances. How much do you need to spend annually? How much cushion do you have? What is your risk tolerance? What other income sources do you have? There is no universal answer, but the principle is clear. Do not sacrifice long-term growth entirely in pursuit of short-term safety. Let me also talk about something that sophisticated dividend investors understand, but most retirees miss. The difference between dividend yield and earnings yield. Dividend yield is simple. It is the annual dividend divided by the stock price. If a stock pays $4 in dividends and trades at $100, the dividend yield is 4%. Earnings yield is the inverse of the price to earnings ratio. If a company earns $8 per S-share and trades at $100, the earnings yield is 8%. Here is the insight. A company's earnings yield represents its total earning power. The dividend yield represents only the portion paid out to shareholders. The difference goes to retained earnings, which the company reinvests. A company with an 8% earnings yield and a 4% dividend yield is retaining 4% of its market value annually to reinvest in the business. If those reinvested earnings generate good returns, the company becomes more valuable, and both the stock price and future dividends can grow. A company with a 6% earnings yield and a 6% dividend yield is paying out everything it earns. There is nothing left to reinvest. The business is not growing. The dividend cannot grow unless earnings grow, and earnings cannot grow without investment. This is why I often prefer companies with lower dividend yields but higher retained earnings. Yes, I receive less current income. But the company is investing in future growth that will benefit me through capital appreciation and future dividend increases. Retirees who focus only on dividend yield miss this distinction. They see the 6% yield and prefer to the 4% yield, but the 4% yield with strong earnings retention may be the better investment because it has better growth prospects. I want to share one more thought about dividend investing in retirement. The emotional relationship that retirees develop with their dividends. There is something psychologically comforting about receiving dividend checks. The regular deposits feel like income. They feel like a salary. They create a sense of security that is independent of stock prices. Many retirees tell me they do not care what their stocks are worth, as long as the dividends keep coming. I understand this psychology, but it can lead to poor decisions. Retirees become so attached to their dividends that they refuse to sell deteriorating positions. They hold on to troubled companies because they cannot bear to give up the income. They watch their principal decline while congratulating themselves that the dividend is still being paid. The dividend is not separate from the stock. If you own $100,000 of a stock paying 5%, you have $100,000 plus $5,000 in annual income. If the stock falls to $60,000 while still paying the dividend, you now have $60,000 plus $3,000 in annual income. You have lost $42,000 of wealth. The fact that a dividend is still being paid does not change this. Emotional attachment to dividends is understandable but dangerous. You need to evaluate your investments based on total value, not just income. If a position is deteriorating, you may need to sell, even though it means giving up dividends. Protecting your principal is more important than preserving any particular income stream. I have given you a lot to think about today. Let me summarize the key principles. First, focus on dividend safety above all else. A safe 3% yield is far better than an unsafe 6% yield that gets cut. Second, prioritize dividend growth over current yield. Companies that grow their dividends protect you from inflation and build wealth over time. Third, avoid yield traps. Abnormally high yields usually signal trouble, not opportunity. Fourth, diversify appropriately, but do not buy bad businesses just for diversification. Quality matters more than checking boxes. Fifth, think in terms of total return, not just dividend income. Growth investments can fund retirement just as effectively as dividend stocks. Six, maintain flexibility. Do not rigidly adhere to rules that prevent good decisions. Seventh, consider tax implications. After-tax return is what matters. Eighth, watch for warning signs and be willing to sell troubled positions before disaster strikes. Most retirees get dividend investing wrong because they focus on the wrong metrics and ignore the real risks. They chase yield instead of seeking quality. They sacrifice growth for current income. They concentrate in dangerous sectors. They hold on to troubled positions too long. You now know better. You understand why the conventional wisdom fails. You understand how to build a dividend portfolio that actually works. The question is whether you will have the discipline to implement these principles or whether you will fall into the same traps that catch most retirees. The choice is yours, but the math is unforgiving. The retirees who get this right will enjoy secure, growing income for decades. The retirees who get it wrong will suffer dividend cuts, capital losses, and diminished retirements. Everything about how you approach dividend investing matters. Get it right, and your retirement will be far more secure than you ever imagined possible.